You're listening to the Limitless Wealth Method podcast. Smart ideas, real strategies, and candid conversations for business leaders. Here's your host, Jason Hilliard.
Hello, and welcome to the Limitless Wealth Method podcast, where ideas shape wealth. I'm your host, Jason Hilliard, and in today's episode, I'm going to cover 7 key themes that are shaping markets right now. This will be a data-driven, macro-focused, easy-to-digest episode that's designed to help you think like an institutional investor. So let's get started. If you've been following markets this year, you've probably noticed something unusual. Almost nothing has gone according to the consensus forecast. We were supposed to see a recession. We didn't. Inflation was supposed to come down quickly. It hasn't. And yet, asset prices remain resilient, corporate earnings are solid, and the economy continues to expand. I don't rely on consensus. I rely on data, probability-weighted analysis, and a disciplined macro framework that tracks growth, inflation, and liquidity across 50 countries. My job for my clients is to anticipate these shifts before they happen, not react after the fact. So today, I want to share what we're seeing beneath the surface. I'll walk you through the big picture environment we call Paradigm C, explain why the economy keeps surprising people, and break down what's happening with inflation in the Fed, and also show you why some of the headline risks, like tariffs, matter less than you actually think. Then we'll talk about Treasury supply dynamics, market positioning, and what all of this means for how you should be invested right now. One more thing before we start. My philosophy is simple. Focus on the forest, not the trees. It's easy to get distracted by daily headlines and bear porn, but what really matters is understanding the macro regime we're in and positioning accordingly. All right, let's get into it. Let me start with the macro framework, what we call Paradigm C. So the U.S. is now operating under what we call Paradigm C. It's a regime defined by 3 things: aggressive fiscal spending, and fiscal spending is just what the government does with the spending and taxes, looser regulation, and a fundamental shift in how the Federal Reserve thinks about inflation. In practical terms, the government is spending heavily to stimulate growth. We're running deficits over 6% of GDP, even though we're not in a recession. This is really unusual. The private sector, especially in technology and manufacturing, is responding with renewed investment. And the Fed is quietly redefining what price stability means. This environment resembles what historians call a fourth turning, or what Neil Howe has coined as a fourth turning. It's a period of major political and economic realignment. Think about the 30s and 40s, or the 1860s. These are moments when societies face structural change, power shifts, and rapid innovation. They can be extremely volatile, but they also create enormous opportunity for investors who stay disciplined. Here's what you need to know. The economy is on a growth trajectory supported by strong balance sheets and corporate investment. Inflation is structurally higher than the last decade, but it's no longer accelerating. And monetary and fiscal policy are increasingly coordinated. And we'll go into that, meaning policymakers care more about sustaining growth than aggressively fighting inflation. So the bottom line is, this is not really your father's economic cycle. The rules have completely changed, and the investors who adapt will be rewarded. So that's really the big picture. Now let's talk about what's actually happening in the economy. Despite all the recession calls, the U.S. economy, as we mentioned, has been remarkably resilient. But there's a disconnect. Let's start with the headline numbers. GDP growth, gross domestic product, has stayed above 2% year over year. That's okay. It's not bad. It's not good. Unemployment is low. Companies are hoarding labor rather than cutting jobs. And consumer spending is cooled slightly, but it's still supported by wage growth and strong household balance sheets. On paper, this looks like a pretty healthy economy. But here's the problem. That's not what most people are experiencing. If you look beneath the surface, lower and middle income households are facing real financial pressure. Why? Well, there are three reasons. First, inflation completely hits unevenly. Essential categories like food, housing, utilities, insurance have risen far faster than the average inflation rate. Rent is still growing 5 to 8% annually in many cities. Auto insurance is up over 20% year over year. And I don't know if anybody has a teenage driver, but that 20% is pretty low compared to what I'm experiencing. And lower income families spend roughly 75 to 80% of their income on these essentials, compared to about 55% for higher income households. That means even modest inflation in core goods translates into a meaningful erosion of purchasing power. Number two, higher interest rates are amplified for families who rely on credit. Credit card APRs are just crazy. They're above 22%, the highest in decades. Auto loans are averaging 8 to 9% if you're buying a used car. Mortgage rates have come down, but you're getting anywhere from, 6 3/8 to 7. And that really has locked millions out of the housing market because lower income households rely more on short-term credit. Higher rates compound their financial strain. And then number three, real wage growth is flat. Nominal wages have risen, but when you adjust for inflation, purchasing power is barely moved. The result is what economists call a cost of living recession. It's where people are employed, but they feel poorer. Many Americans, they're drawing down on savings built up during the pandemic, and credit card balances now exceed 1.3 trillion, which is a record high. Now, this divergence, where the macro data looks strong, yet households feel squeezed, is one reason consumer sentiment remains depressed, even amid an economic expansion. Now, here's why this matters for investors. Persistent inequality and cost pressures can and will influence consumer spending, politics, and ultimately policy decisions. So in the coming years, expect continued government focus on income support, tax credits, and subsidized financing programs. And these efforts may soften the pain for households, but they also reinforce the structural forces keeping inflation elevated. So when you hear the economy is strong, just remember it really depends on who you ask, which brings us to inflation in the Federal Reserve. As everyone is well aware, inflation has come down from its 2022 peaks, but it's proving stubbornly sticky. Let me explain why. It's not because of the reasons most people think. This isn't about supply chains or energy prices. It's structural. What do I mean by that? Well, wages, household costs, and government spending are all contributing to a higher for longer environment. And at the same time, the Federal Reserve's independence is gradually eroding. This is what economists call fiscal dominance. It's a state where monetary policy, which is what the Fed does with interest rates and money supply, is effectively subordinated to the government's financing needs. And here's what's happening. The federal government is running massive deficits, over 6% of GDP, which is unheard of. At 6% may be a small number, but in the grand scheme of things, it's massive, even outside of recessionary periods. So the Treasury is issuing record amounts of debt and interest payments that now exceed 1.1 trillion annually. The Fed knows that pushing inflation back down to 2% would likely require a recession. So they're quietly shifting toward a 3% equilibrium inflation target. And this represents a structural change in how policymakers define price stability. So what does this mean for you, the investor? Over the next few years, we expect a gradual decline in real interest rates, which supports risk assets. We also expect potential balance sheet expansion by the Fed in the form of targeted bond purchases. Essentially, it's more quantitative easing. or QE. And later in the decade, believe it or not, I think we may see a move toward yield curve control to manage borrowing costs so rates don't get too high. In simple terms, the era of tight money may already be behind us. The Fed is unlikely to risk destabilizing growth when both the economy and the Treasury depend on affordable borrowing costs. This is a major shift, and it has profound implications for how you should be positioned. Now, let's talk about one of the biggest headline risks, tariffs. Tariffs have been all over the news, but I think the market is overreacting. And here's why I say that. Recent headlines have focused on renewed tariffs and trade tensions. And while tariffs make for eye-catching news, their broader economic impact is likely to remain limited in this cycle. Here's the key insight. The U.S. economy is now services dominated, not goods dominated. Services account for roughly 70% of total GDP and about 2/3 of consumer spending. Goods, on the other hand, goods consumption, by contrast, represents less than 30%. And much of that spending is on domestically produced items like food, autos, and energy. That means tariffs, which primarily target imported goods, touch only a narrow slice of the total economic activity. Even sizable tariff adjustments tend to shift pricing and supply chains more than they shift overall growth or inflation trends. Second, supply chains have already adjusted. These companies have already adjusted. After several years of reshoring or nearshoring or diversification following the pandemic years and earlier trade disputes, global supply chains are more flexible now. Companies have learned to navigate tariffs by reallocating production, adjusting inputs, or passing these modest costs along to consumer. Our data shows that the import share of total U.S. goods consumption has already declined meaningfully since 2018. Third, the inflation channel is contained. Tariffs are inflationary, yes, at the margin, but the effect tends to be front-loaded and transitory. It's really because the consumer basket is mostly services. It's not goods. So housing, healthcare, education, entertainment, tariff-driven price increases on goods have a diluted impact or effect on overall inflation metrics. Let me give you an example, an easy example. So let's say a 10% tariff is placed on $500 billion of goods imports. That would mathematically add only about 0.2 to 0.3 percentage points to headline CPI, assuming you get a full pass-through. And in actual pass-through, it's going to be typically less than that. So the bottom line is that we see tariffs as a part of a larger policy trend toward strategic industrial independence away from China and a number of other countries. It's not an existential threat to growth. Certain sectors may experience volatility, but the macroeconomic ripple effect will likely be modest. For investors, this means short-term noise, not long-term disruption. Now, let's get into something more technical, but critically important. It may be the most important thing that I'm going to talk about, which is Treasury supply and debt dynamics. And I'll do my best to explain this in very easy terminology. So it may sound like a dry subject, but it really is an important macro theme for the next several years, and it will impact your portfolio if fixed income is a portion of it. So we have had a sharp increase in Treasury supply and the changing composition of how that debt is financed. This matters because it directly impacts liquidity conditions, interest rates, and ultimately asset prices. So here's what's happening. The U.S. Treasury is projected to issue roughly $1.8 trillion in gross marketable debt this year in 2025. That amount rivals pandemic era financing, as we mentioned before. But this expansion isn't tied to emergency spending. Same amount as more than we had in emergency spending during the pandemic years, but it's crazy how much that they're doing in a non-pandemic year. So it reflects an ongoing fiscal commitment in defense, industrial policy, entitlement programs, and interest payments that now exceed 1.1 trillion annually. So I think the most important thing to note about that 1.1 trillion annually is how that actually breaks down. So let me explain. So Luke Groman has a really helpful metric called the true interest expense of the US government, which has an annualized growth rate of 12%. What is true interest expense? It's Medicare plus national defense plus net interest, the interest the government pays on their debt, Social Security. Those four are 63% of the US budget. If you add in Medicaid, it's 72% of the US budget. So 72% of the US budget is off limits, or what would be considered non-discretionary. And that grows at 12% per year. So thus, the 28% of the budget is everything else. This is why DOGE was never going to be that successful at cutting the budget deficit. And it wasn't their fault. It's just because 72% is off limits of the US federal budget. If DOGE cut all discretionary spending, it would only reduce the deficit from 6% to 6% of GDP to 4%. That's not much. It's something, but it's not much. In short, Washington is borrowing heavily during an economic expansion. That's a dynamic the US hasn't seen in decades. Now, here's where it gets interesting. For most of the past 20 years, foreign central banks, notably Japan, China, and Germany, were consistent buyers of treasuries. They purchased for policy reasons, not yield. But that trend is reversed. Our data show that foreign official holdings have declined by nearly a third since 2015, while domestic investors like us now hold about 57% of total treasuries. That was previously 34%. So in the past 4 years, it went from 34% of domestic investors holding treasuries to 57%. That's massive uptick. So these domestic holders, these banks, these money market funds, pensions, households like ours are considered price-sensitive buyers. In other words, the U.S. market must now continually reprice its debt high enough to attract its own citizens to fund the deficit. That shift raises the cost of capital across the economy and makes treasury auctions more sensitive to changes in liquidity and sentiment. Third, the Treasury has completely adjusted its issuance strategy. So it leans more heavily on short-term bills rather than long-term bonds. Bills now make up 22% of the total marketable debt, which is up from around 15% just 2 years ago. Why the heck does this matter? Well, short-term financing reduces immediate duration risk. It's easier to sell bills because investors can park cash for 3 to 6 months without taking on any long-term rate risk, right? It also temporarily eases pressure on long-term yields. I think everybody's more comfortable putting their money into a 3 to 6 month, treasury bill, knowing that they're going to get that money back when they need it or if they need it. But it also increases rollover risk because every bill has to be refinanced several times a year. And as the outstanding stock of bills rises, the government becomes more exposed to short-term rate volatility. And this creates what we call fiscal reflexivity. Nothing you need to be too worried about, but that's a technical term for it. It's a structural mismatch between short-term funding and long-term obligations. So if you remember back in March and April of this year, we saw the US equity market break down around 20%, and we saw a spike in yields, which is very uncommon and very dangerous. The administration was basically attempting fiscal restraint in order to reduce the debt load, which absolutely did not work. Scott Bessent was looking into a black hole because as yields spiked and equities tanked, this very well, or that very well, could have evolved into a full funding crisis if it had persisted, which is why the administration switched course in mid-April, and decided to start trying to outgrow the debt problem, not reduce the spending. So the system now depends on continuous liquidity support, either from Treasury drawdowns, the Fed, or foreign central bank balance sheets to keep yields contained. So here's why this matters for markets. When the Treasury issues more bills, it pulls cash from the financial system into short-term government paper. Yes, obviously. This effectively drains liquidity from risk assets. Conversely, if the Treasury eventually increases longer-dated coupon issuance, it could push long-term yields higher and tighten financial conditions. And this evolving dynamic helps explain why long-term yields have been more volatile in 2025 and why markets are struggling to price equilibrium interest rates. So the Treasury market is adjusting to a new era of price discovery where yield levels are dictated not by central banks, but by actual supply and demand. The bottom line is this transition represents a structural shift in the global financial system. And over time, the growing reliance on short-term bills and domestic buyers may lead to greater sensitivity of markets to policy shifts and liquidity swings. Disciplined investors, this environment reinforces the importance of diversification, active risk management, in my opinion, and tactical flexibility. So given all of this, paradigm C, sticky inflation, fiscal dominance, Treasury dynamics, how in the world should investors be positioned? Let's talk about what this all means for your portfolio. So we have macro models, and they currently identify the prevailing environment as a Goldilocks regime. And that basically means it's a regime where growth remains firm and inflation is contained enough to support risk-taking. Historically, this regime has rewarded risk assets over defensive holdings, specifically equities over bonds, cyclical and growth sectors over defensive, small cap and mid caps over large caps, emerging markets over developed peers, and gold and real assets over cash and treasuries. Liquidity is also expanding globally, and central banks across major economies, including China, are easing financial conditions, and the US dollar has begun a gradual decline, which, believe it or not, typically serves as a tailwind for global liquidity and asset prices. As global liquidity goes up, typically asset markets go up with it, or I should say equity markets go up with it, and liquidity is a big component of what we look at. A weaker dollar is also good for US corporate profits, since nearly 40% of the S&P 500 revenue comes from overseas. That said, even though there are some sectors that are supposed to do well than others in a Goldilocks environment, not all assets will benefit equally. Markets have already priced in a lot of optimism. So we expect more dispersion across sectors and styles. This is a market environment where selection and timing matters more than simply being invested. So choosing the right factor exposures will be paramount to positive portfolio returns. One more thing. Foreign central banks led by China and the Eurozone are diversifying away from US Treasuries, and they're increasing their gold reserves. That adds another layer of support for precious metals over the coming years. As you'll notice, gold and silver are some of the best performing assets over the past few years. And part of that is due to central banks bringing or buying large amounts of gold and silver. Now, if you're sitting in a traditional 60-40 portfolio where you have 60% stocks and 40% bonds, here's what I'd say to you. That allocation worked for decades because bonds provided diversification and they provided downside protection when stocks fell. But in an environment of fiscal dominance, higher structural inflation, and coordinated monetary policy, bonds may not play that role as effectively. In fact, I know it won't play that role as effectively. We have a very large beta between the two. They kind of move in tandem. So there's no diversification element anymore for a 60-40 portfolio. Instead, what do you need? You need a multi-asset risk-managed strategy that can adapt as conditions evolved. That means incorporating some alternatives, some real assets, and tactical positioning based on where we are in the macro cycle. This is exactly the approach that I use. It's a disciplined approach, probability weighted, and designed to protect and grow wealth through different regimes. So let me wrap up with some practical takeaways because we've covered a lot. So let me try to bring this all together. So first, number one, we're living in paradigm C, an era of fiscal expansion, coordinated monetary policy, and structurally higher inflation. This is a totally different economic cycle than what we've seen in history. The government's spending aggressively, the Fed is adapting its inflation target, and policy is increasingly focused on sustaining growth rather than fighting inflation at all costs. So you have to understand this regime. It's going to be critical to making smart investment decisions. Second, the rules have changed. The traditional 60-40 portfolio, as we mentioned before, won't provide the same protection that it once did. You have Treasury supply dynamics, fiscal dominance, and shifting liquidity conditions, which all mean you need a more sophisticated approach, one that incorporates alternatives, real assets like real estate or gold or silver, and you have to be actively managing those assets. Third, this environment represents opportunity for disciplined, flexible investors. Yes, there's volatility. Yes, there's uncertainty, but periods of structural change, fourth turnings specifically, have historically rewarded those who stay informed and stay invested and stay focused on the long term. Look, if you made it this far, thank you. You're clearly someone who thinks about this stuff seriously. And that's honestly the most important part, just paying attention to the regime we're in, not getting caught up in the noise. Because these days, the amount of noise that goes through everything from X to any other social media channel is just insane. So I honestly, I don't have a crystal ball. Nobody does. But what I do know is that investors who do well over the long run are the ones who understand the macro environment. They stay disciplined and they don't panic when things get volatile. If this was helpful, which I hope it is, I'll be back next week with another update. And if you ever want to talk through how any of this applies to your situation, no pressure, no pitch, you know where to find me. Just reach out. And thank you very much for listening. I'm Jason Hilliard, and I'll see you on the next episode.